Hello, and welcome to Newswave. Salaried employees' payslips are set to shrink further if a proposal by the Treasury to eliminate reliefs on pay-as-you-earn (PAYE) taxes is adopted. The Treasury in its newly published medium-term revenue strategy plans to review the current tax reliefs on earnings from employment to maximize collections. Though the tax incentives provide governments with a policy tool to influence taxpayers' behavior, they come at a cost in terms of foregone tax revenue. In addition, tax incentives increase the complexity of the tax system and reduce its effectiveness as an instrument to promote equity. Studies have shown that incentives may not necessarily be effective in influencing the taxpayer's behavior, the Treasury said. Currently, salaried workers enjoy two types of tax reliefs on PAYE, including a 2,400 shillings monthly personal relief for all resident individuals, which is meant to lighten the tax burden on the taxpayer. Additionally, salaried workers who have paid insurance premiums for life, health, or education policies for themselves, spouses, or children enjoy a relief of 15% paid up to a maximum of 60,000 shillings per year. The education and health policy must, however, have a maturity of at least 10 years to qualify for the tax relief. Additionally, from January last year, contributions to the National Hospital Insurance Fund (NHIF) were qualified for insurance relief. The Treasury's proposal to axe either or all of the tax reliefs has, however, puzzled tax experts who reckon the move would only further impact the disposable income of households who are already adjusting to the recently introduced housing levy at 1.5% of gross salaries and higher deductions to the National Social Security Fund. How you tax households is very important as it has the ripple effect on purchasing power. This would affect the revenues and profitability of companies and ultimately GDP. The economy is run by salaried workers whom I call the middle class, Francis Komau, a partner and tax leader at Ernst & Young said. The National Treasury has nevertheless outlined mitigation measures for the elimination of the tax reliefs, including setting a new PAYE tax band at 0%. With the removal of personal relief, the low-income tax earners will be cushioned in line with the adjusted tax bands by creating a zero-rate tax band, the Exchequer added. At the same time, the government is mulling over cushioning top earners by trimming the top PAYE tax rate from the recently introduced ceiling of 35% to 25% in a restructuring of tax bands to eliminate opportunities for tax avoidance and evasion. The move comes just 3 months after the 2023 Finance Act introduced two new tax bands at 32.5% and 35% on monthly employment income above 500,000 shillings and 800,000 shillings respectively. The new PAYE bands were viewed as ineffective in yielding higher revenues for the Exchequer from employment income. The anticipated increase in revenue may be negligible given that the majority of employees in Kenya earn below 100,000 shillings per month, noted tax analysts at KPMG. Currently, workers with salaries up to 24,000 shillings a month do not pay PAYE taxes owing to the personal relief of 2,400 shillings, which matches the 10% rate of tax on the lowest tax band. The remainder of salaried workers incur pay taxes at the rate of 25% and 30% respectively. Thank you for joining us at Newswave 254, and that's all for today's headlines.